It's a Tuesday in Columbus, Ohio, and Daniel Reyes, 34, is standing in a grocery store holding a carton of eggs that costs $6.40. The man next to him, same carton, same store, same minute, is paying $4.90. Neither of them knows. The shelf tag is dynamic. The price is whatever the system decided each of them would pay without walking away. Daniel makes $78,000 a year. He has $11,000 in savings, a 2019 Honda with 92,000 miles on it, a Roth retirement account he opened a few years ago and forgot about, and a quiet habit of buying things on Sunday nights when he's anxious about Monday. The system knows all of this, not in a vague advertising sense. It knows it the way a careful accountant would know it, except it never sleeps, never forgets, and never works for him. This is the part most people miss when they think about AI and money. The danger isn't a machine watching you spend. The danger is a machine that has watched you spend for years, learned the exact moments your discipline breaks, and quietly built a price tag that lives on the other side of those moments. So let's walk through what a single week looks like when that infrastructure is fully online. Most of it already is. The rest is 2 or 3 product cycles away. Monday, 7:14 a.m. Daniel opens his banking app. The interface looks friendly. It tells him his safe-to-spend number for the week is $312. That number isn't a calculation of his income minus his bills. It's a behavioral forecast. The model has predicted, with around 88% confidence, what he will actually spend, what he'll regret, and what he'll quietly transfer from savings on Thursday night to cover. The 312 isn't advice. It's a leash with a soft handle. By Tuesday at lunch, the leash is already being tested. He orders a sandwich through an app. The price is $13.50. Last week, it was $11.25. There was no menu change. The model noticed he ordered 3 times last week despite a tight budget signal, which means his price elasticity for this specific restaurant, at this specific time of day, in this specific emotional pattern, is low. He'll pay more and not switch. So he pays more. He notices, vaguely. He doesn't act. Wednesday morning, his car insurance renews. The premium is $164 a month, up from $151. The renewal notice mentions updated risk factors. What it doesn't mention is that the model has read his location data, his late-night convenience store visits, the increased frequency of fast food charges, and the slight slowdown in his retirement contributions, and concluded that he is in a soft financial decline. People in soft decline drive differently. They file claims differently. They pay anyway. The premium reflects that. This is the first thing to understand. When a system knows every dollar you spend, it doesn't just observe you, it prices you. And the price is not the price on the shelf. The price is the largest number the model believes you will accept without changing your behavior. That night, Thursday, around 9:45, Daniel is tired. He opens his phone. An ad for a $79 pair of running shoes appears, except it isn't really $79. For someone else, the same ad shows $64. For someone with a higher savings rate and lower impulsivity score, it might not appear at all, because the model has learned that disciplined buyers anchor on lower prices and complain. The ad is a quiet form of triage. Daniel is in the tier that gets shown the higher anchor at the more vulnerable hour. He buys them. He tells himself he needed them. The system already knew he would. By Friday morning, the smaller charges have stopped registering. His rent auto-pays $1,675. He doesn't think about it. but somewhere in a leasing company's pricing engine, a renewal offer for July is being drafted, and it's drawing on data the landlord legally doesn't have, but legally can buy. It knows Daniel got a small raise in October. It knows his job tenure is now over 4 years, which makes him statistically less likely to move. It knows his dating app usage dropped, suggesting a stable routine. The renewal will come in at $17.95, not because the market demands it, because his market does. Saturday, he tries to refinance a $7,400 credit card balance. The personal loan offer he sees is 18.9%. His coworker, with a nearly identical credit score, sees 14.2. The difference isn't credit, it's behavior. The model has read Daniel's transaction history and concluded he carries balances longer, pays minimums more often, and is therefore worth more as a borrower than as a payer. He is, in the dry language of the system, a high-yield account. He's being charged for being predictable. By Sunday night, Daniel has spent roughly $620 across the week, of which somewhere between $40 and $90 was a tax, not a government tax, a personalization tax, a markup that exists only for him, only because the system can see him clearly, and only because in this version of the economy, visibility flows one direction. He sees a price. The price sees his entire life, and Daniel is not unusual. He is a single point inside a labor force of roughly 170 million Americans, almost every one of them generating the same kind of behavioral exhaust every hour of every day. The financial system has always had asymmetric information. Banks knew more than borrowers. Insurers knew more than the insured. What's new is the resolution. It used to be that the system knew your category. Now, it knows your Tuesday. And here is where it gets quietly disturbing, because the second-order effect isn't pricing, it's identity. When a model knows every dollar you spend, it begins to know what you are before you do. It can detect a divorce months before it's filed, based on spending pattern shifts that show up in the data long before they show up in conversation. It can detect early depression through a specific signature. Rideshare frequency dropping, grocery spend dropping, delivery spend rising, subscription churn slowing. It can detect that you're about to quit your job before you've decided. The system can read your future from your receipts, and that information has buyers. Health insurers want it, employers want it, landlords want it, lenders want it, political campaigns want it. None of them need your permission, because the data is laundered through enough intermediaries that no single transaction looks invasive. The whole shape of your life becomes a product sold back to the institutions that decide what you can access. The strangest part, the part that doesn't feel like dystopia, because dystopias are supposed to feel loud, is that none of this looks like surveillance from the inside. It looks like convenience. The app is helpful. The recommendation is relevant. The price is personalized. The loan is tailored. The premium is based on your profile. The language is gentle. The math is not. So what does life actually look like when AI knows every dollar you spend? It looks like a world where two people earning the same salary, living in the same city, working the same job, end the year with thousands of dollars of difference between them, not because of discipline, not because of luck, because one of them was legible to the system in a way that made him cheaper to extract from. He paid the personalization tax in 100 quiet places. He never saw it on a receipt. And here is the part Daniel will eventually have to understand, even if he doesn't yet. In the economy that's already arriving, the people who keep the most of their own money won't be the ones who earn the most. They'll be the ones the model can't quite forecast. The ones whose Thursday nights don't match their Tuesday afternoons. the ones who occasionally violate their own pattern, not as a strategy, but as a way of remaining a person instead of a profile. Because the model prices confidence. A person it can't predict is a person it has to widen its margins around. Wider margins mean a lower personalized price. A lower personalized price means more of your life stays yours. That, in the end, is what financial freedom is quietly becoming. Not how much you earn, not how much you save, how expensive you are to predict. Daniel doesn't know any of this yet. It's still Tuesday. He's still holding the carton of eggs. He puts it in the cart. He pays $6.40. The man next to him pays $4.90. They walk out through the same doors, into the same parking lot, into two different economies wearing the same clothes.